Salam, TETB. Good morning and good wishes to all. Welcome to One Wealth Outlook and our first market update for March. My name is Sagara Kusuma, and today I'm here to give you the insight and analysis on global markets and our economic recovery so far, to help you make the best investing decisions. So let's take a look. In the past week, global FX, bond, and equity markets have experienced significant volatility in reaction to the jump of the 10-year Treasury yield. Last week's 24-point spike, along with a disappointing Treasury auction, caught markets by surprise, triggering a pullback in global equities. The S&P 500 pulled back 4% from its all-time high, while the Nasdaq was at one point down 7.69%. Asian stocks suffered the biggest slump since March sell-off last year, and globally, the global Morgan Stanley Composite Index fell as much as 4.42%. Now, the climb higher for Treasury yields were expected, just not at such a rapid pace. They jumped on the perceived risk of further inflation and accelerating economic recovery. But overall, there remains a relatively controlled expectation for now. It was essentially a tantrum without a taper as the US Fed and Jerome Powell continue to hum a very accommodative and dovish tune, being in no rush to pull back support. Furthermore, the US House has passed a bill for a further $1.9 trillion in stimulus, and now has passed it on to the Senate for consideration. We expect the final bill to be passed in the coming week. This injection of support comes at a time when the recovery is still ongoing and remains fragile. But we are by and large recovering, particularly in Asia, where manufacturing has picked up. We can see the light at the end of the tunnel. Over 241 million doses have been administered worldwide so far, and we are administering vaccines at an increasing rate of roughly 6.7 million doses a day. Indonesia has so far administered over 2.59 million doses. And last Sunday, the CDC approved Johnson & Johnson's one-shot vaccine. The effective rollout of vaccines and return to normalcy is as crucial as fiscal stimulus for a proper, sustained economic recovery. Another trade that's been gaining momentum is the recent commodities boom. In the past few months, commodities have been on fire, not being this popular of an asset class or performed this well since early 2000s. The Bloomberg Commodity Index is at its highest level since 2018, having risen over 47% since the 2020 March lows. Now the question is, are we in a super cycle? Or just a boom caused by pandemic-induced supply-side shortage? Now, a super cycle is a long period of time where abnormally strong demand occurs the same time that producers are struggling to match in production. This causes prices to rally like crazy. Now, it's happened before. We currently have a very robust backdrop for commodities overall to continue appreciating in value. China's stockpiling and return to normal production levels, Asia's manufacturing pickup, as well as a coming US recovery, a weakening dollar, and inflationary concerns pushing investors towards a hedge. Now, what exactly does this mean for metals? Industrial metals are picking back up amongst return to normal, but there is a larger backdrop of the transition to greener, renewable energy, pushing a number of key metals higher. Iron ore has been the best performing base metal of the past year, with DCE having increased more than 90% in the past 12 months. Now, these prices were mainly driven by Chinese demand, but also the loss of Brazilian mining production capacity. In the medium term, Made in China 2025 will likely keep the demand for iron ore and its industrial friends rather high. Likely copper, zinc, aluminium, lead, nickel, and tin will continue coming up in the near term. But out of that group, copper and nickel are considered to be the critical materials for renewable technologies and transition. So let's start with copper. Copper continues to climb, currently at $9,172 per metric ton. The PhD of Metals' winning run over the past 12 months is the longest month-on-month rally since trading began in the London Metal Exchange in 1986. Likely a result of supply disruptions among mines in Chile and Peru, the world's leading producers. Our analysts expect a further rally from current levels to over $10,000 per metric ton. On nickel, there is an increasing demand for it globally as the key component of electric vehicle battery technologies, and other renewable tech. The boom represents pent-up demand finally being unleashed into the market after the shock and disruptions of last year. Currently, nickel is at its highest level since September 2011, over 75% gain in value from its 52-week low last March. Indonesia overtook China in 2020 to become the world's leading miner and supplier of nickel pig iron. In 2020, China's imports of NPI from Indonesia rose 109% year-on-year to 2.7 million tons. Nickel is also suffering from supply constraints, and generally there are very few new projects in development anywhere. And now gold, poor gold, has been heading for its worst month since late 2016, as a stronger dollar and expectations for a rapid economic recovery and vaccine rollout relatively diminished the demand for a traditionally safe haven asset. It peaked last August at $275 an ounce, and since has progressively come down below its 200-day moving average and support level of $1,800. With the abundance of liquidity and cash in financial markets, though, we should expect gold to steady in the longer term and not repeat its 2011 collapse. But there may be further downward pressure in the event of broader market sell-offs. We should talk about food for a second, because global food prices are at their highest in 6 years, having risen for 8 consecutive months as well. The FAO Food Price Index is at the highest level since mid-2014. Now that's only 16% below its all-time high. The highest movers being soybeans and palm oil, reaching a 7-year high due to strong demand from China again and stockpiling. The fragile supply chains and adverse weather also impact price movements. We should consider oil as well, since it's been making some very interesting moves. After reaching a 1-year high last month, OPEC Plus will continue to manage production and ensure that oil prices are under control. So far, they've been able to balance the deficit of demand by restraining supply. Inventories are the key measure here to see where prices may move. Now that's all well, but there are still risks to our analysis. The sharp rise in prices is unlikely to sustain time after time after time across all commodity groups. For example, even though current projections show that there may be a sizable supply gap in some key metals all the way to 2030, the climate policy that has supercharged their demand may end up negatively impacting energy products longer term. From us, that is all for today. I am Sagara Kusuma, and this has been One Wealth Outlook Weekly Update. For more updates, click on the link below to follow our weekly market journal, and don't forget to hit the subscribe button below. Salam, PITB.